The Kansas City Fed has a way of often picking a topic that turns out, they pick it a year ahead, and yet it is an important focus. And I add to their theme inflation, but certainly that is a big deal because its inability to boost inflation, even with stronger growth in tight labor markets, is more than a U.S. phenomenon.
So here's what I think is going on, and I think it helps explain why we're trying to come to grips with this. Historically, when we run this level of unemployment, 4.3% now, and if you look at broader measures of slack, we're moving toward full employment. You'd normally, historically, have seen wage pressure, and you'd see that transmit into more price pressure. We're not seeing that like we have in the past. To me, there's a couple of reasons, and they're structural. They're not cyclical, they're structural. One is globalization, where there's overcapacity in the world, particularly in China, which creates downward pressure, or puts a dampening effect on prices. But the second big trend, which is newer over the last number of years, is technology-enabled disruption. Technology is replacing people, new business models are replacing old business models, and consumers are able to use technology to shop much more effectively, and the result of that is businesses have less pricing power than at any time in my life. And so I think you've got the cyclical forces that are clashing with the structural forces, and I think the structural forces are relatively new and very powerful. And so the net of it is, I think we need to take more time to try to understand it, but it also tells me that the natural rate of unemployment may in fact be lower than we're historically accustomed to because of these very strong structural factors.
You know, it's interesting to me that for years people seem to think that Japan was a special case. They had 20 years of deflation, and of course they're having a hard time getting their inflation rate up. But it seems to me that over the last year or so, more countries, including the U.S., are having the same difficulty.
And here's what Japan and the United States and various countries in the Western world have in common: aging populations, slowing workforce growth. Japan has it worse than the United States, but the entire Western world, by and large, has aging population, slowing workforce growth. GDP is made up of growth in the workforce and improvements in productivity. And if you've got an aging population, you need to find ways to grow the workforce. That could be skills training, it could be getting more women in the workforce, but one of the other ways is immigration. Historically, the United States has relied on immigration to grow the workforce. Obviously, there's a national debate about that, but the fact of the matter is these demographic trends aren't talked about enough, and they're affecting Japan, you mentioned, but a whole number of countries, which helps explain why we've had sluggish GDP growth.
So what can central banks do about this?
The most important thing I can do as a central banker is adapt to reality, meaning my job is not to think about what would have been the appropriate Fed funds rate or monetary policy 5 years ago or 10 years ago. It's what it should be today. And so a big part of our job at the Fed, and my job as a central banker, is understand the economic models, spend a lot of time with economists, but I need to spend a substantial amount of time understanding businesses, talking to businesses, and understanding the global economy, including going to China regularly, because I think those other factors are having a significant effect on the state of economic conditions. And I think the result of that is the neutral rate, the rate at which we're neither accommodative or restrictive, is likely much lower than we're accustomed to historically, and we've got to adjust to that.
So when you look at these global forces, demographics, things that Federal Reserves and central banks can't change, have you maybe come to doubt or just kind of lose faith, number one, that U.S. inflation, let's get very specific, can head back towards target, or that it even matters?
I think the key is you got to adapt to reality. So no, I haven't lost faith that inflation may well get back to its 2% target. It's that you have to understand the historic cyclical forces and the models that would have suggested what the cyclical forces, what the impact they should have, are being offset by new forces, which you can understand mainly by looking at industries and companies and talking to CEOs, and I think those are having a muting effect on inflation. So it's not black or white. It's that we may well find that we can run a lower level of employment in order to build these cyclical forces to overcome some of these structural headwinds that we now face. I think it's more that, and we've got to just adjust and adapt to that.
Well, There's a lot of talk in Japan, people watching the Bank of Japan saying, you know, the 2% target's unrealistic. Why don't they just give up that target? Why don't they adopt a lower target? Is that something the Fed should consider?
For the time being, I would say no, and here's why. You know, we have a history in this country, and we went through it in the Great Depression, and Japan has been concerned about it, and that is, the concern is deflation. High inflation is not something you want, but you also don't want deflation, particularly when you're this highly leveraged. U.S. government debt held by the public is about 76% of GDP. Unfunded entitlements, present value is about $46 trillion. Japan's government is very highly leveraged. And if you've got deflationary forces, it's very hard to deleverage. And so too high inflation is dangerous, but too low inflation is also dangerous. And I think that was probably the thinking in picking the 2% target. And I still think that thinking is pretty solid.
Okay. You just mentioned China. You go there regularly.
Yeah,
so
I do.
Obviously it's important to you as a policymaker. It's important to you as you think about the U.S. and where we're going and where Fed policy needs to go to do more, to know more about China. Why? How does China factor into this for you?
So first of all, and I've been going to China during most of my business career, but China's changed a lot since I've been going there. And the biggest change, it's dramatically bigger. When I first started going to China, the economy was being driven primarily by state-owned enterprises. What's happened is China has worked very hard to reform state-owned enterprises. They're not there yet, but also build a private sector away from state-owned enterprises. And they today have a strong, growing private sector and a growing middle class, and the country is a dramatically bigger percentage of the world than it was 20 years ago. And here's the issue with China, which is why we're watching it closely. One, it's important. So I go there because it's a big part of global growth. But number two, in order to get that growth, unfortunately, one of the things they've done is dramatically increase their debt. They basically, over the last number of years, doubled debt to GDP across sectors in order to create 6.5% GDP growth. And so my own view is that's not sustainable either. They've got their own demographic problem also because of the one-child policy. And I think China's ultimately going to have to stop building debt in order to build up GDP. They're going to have to let GDP float. It's going to be something lower than 6.5%. And the world's going to have to get used to lower levels of GDP growth. In the meantime, they're worried about capital outflows that can have and those can have a very destabilizing effect. We saw an example in the first quarter of 2016. Seems like a long time ago, but it wasn't, where they had currency outflows, they had sell-off in their markets, and it dramatically tightened global economic and financial conditions. And the Fed had to adjust to that very quickly in order to make sure that we were able to continue to grow in the United States. So China's big enough and significant enough, and they have enough imbalances there. We got to watch it carefully.
There's a question I'd like to ask you about in the rest of the world, looking at the U.S., looking at the Federal Reserve, and knowing that there may be a change of leadership.
That's
going to happen next year in Japan, possibly. Governor Kuroda's term is going to be up. And changes of leadership succession can often make people nervous. People have said, oh, that's hanging over the Jackson Hole conference. But when you look at the rest of the world, what should they know about this process?
So I'll look at this and I'll comment as a business person and someone who caught leadership at Harvard for 10 years, and I've worked with boards my entire career. The sign of a strong institution, a strong company, a strong anything, strong country, is the ability to execute succession and do it in a way with resilience. And I think the Fed is a very resilient organization. I've just been here 2 years, but since I've been here, I see different seats around the table changing, people retiring, new people coming in. I've seen governors change and go out. And I'm quite confident because of the resiliency of the Fed. Our practices, our methodologies, our very strong people, very dedicated people, the Fed. If we do have a leadership change, and I don't know that we will, but if we do, I think the Fed will continue to do its job. The people around the FOMC table will all continue right on and do our work. We'll adapt to the new people around the table, and we'll continue to be very resilient.
Robert, I just want to get back onto your experience when it comes to China. You know, there are some analysts out there that say, look, there are two key problems. One is they need to let the yuan go, right? And the other one is that they have this closed capital account. Do you think reforming those two aspects would help with the deleveraging process, or do you think China, given the amount of debt that has built up and given the kind of expense that they've had to pay to get these levels of growth, that a sort of a hardish landing is going to be inevitable?
It's complicated because there's a number of factors that Chinese officials need to look at when they're thinking about this. Number one, there's the social factors. There's inequality, income inequality there. There's the rural areas, there's the cities. It's estimated that China is going to have to convert something like 400 million people living in rural areas to city dwellers, or change the rural areas into cities. That's a dramatically large social experiment. The other thing is, you mentioned, they have to worry about capital outflows and they have to worry about financial stability. So I think this is a tough one. What they're going to have to do is gradually stop building debt to GDP, be willing to accept probably a lower level of GDP growth, and have confidence that with a growing private sector, they can manage that. In the meantime, they've decided to put on very strong capital controls because the prospect of letting GDP float and the prospect of some of these actions has caused people to want to hedge their bets and move money outside. So they've got to manage all those things. Reforms are critical. Financial reforms, market reforms, currency reforms, and I know they're very aware of that, and it's just a matter of how quickly they can calibrate these changes. They don't want to do it too quickly to create instability, but they also don't want to let these things fester, and so I think that's what they're struggling with.
Robert, just a big picture question. You know, this has been a year of, I think, almost like existential crises or existential pondering for not just the Fed, not just the Bank of Japan, but, you know, central banks really globally about where's the inflation. Is the idea of having better global growth, better corporate earnings, lower inflation for longer really such a bad thing? We heard from Mario Draghi earlier this week saying that policymakers should be more open-minded. Should they be more open-minded when it comes to their mandates?
Well, so it's funny you mention that, because, yes, I've talked a lot about the fact this issue, wrestling with inflation, is not necessarily a bad issue to be wrestling with, and that we've got, I think I'm worried that growth needs to be higher. So 2% plus growth in the U.S. I am concerned about. But the fact that we're able to continue to grow, take labor slack, get more people employed, companies are doing better, the global economy is doing better, and we're still not spurring undue price pressures. Yeah, if you step way back, you'd say, I know you're agonizing over this, but it's not a bad situation. And so I agree with you. It's not a sign of failure of the central banks. It's just it's a sign of a policy challenge that central bankers need to come to grips with and work their way through. And I'd put it that way. I don't think there's a crisis at all in this area.
Just want to ask you, because you do pay so much attention to the global economy and global markets. The Federal Reserve is on a path of normalization, so that seems to be a given. But what about emerging markets? What about the reactions in markets like that? How much does that factor into your thinking? And do you think there's a little bit of complacency right now in emerging markets about the Fed moving?
Well, I think at a time where the world thought the Fed, maybe a year and a half ago, where the world thought the Fed was going to move potentially very rapidly, and people might have also thought the neutral rate that was higher than they might think it is today. I think that might have had some destabilizing impacts on flows to emerging markets. I think that's settled down. Some of that settled down when the Fed sort of tamped down its expectations for the path of rates back in the first quarter of 2016. And I think since then, I think we've seen a period of healing, healthy capital flows, and now more healthy growth in emerging markets. Do I think it's complacency? I don't. I think it's a little bit the Fed has adjusted. Maybe central banks around the world adjusted, but I think the Fed has adjusted that the path of removal of accommodation, yes, we're on the path of normalization, but it needs to be done gradually and patiently. And yeah, we have in the back of our mind that abrupt moves might create destabilization around the world. But I think at the moment, I don't think there's complacency. I think the world has adapted to maybe a more muted pace of removal of accommodation.
Well, again, to come back to this question that Heidi just raised of Mario Draghi and the speech he gave, I thought one of the most simple, basic, interesting things he said was, you know, we've used these new tools and we're not exactly sure how they work. And yes, we're trying to figure it out. We're doing research. And of course, I think to me, it's like him saying, you guys, we can't tell you exactly what we're going to do on tapering or anything else. We're kind of figuring this out as we go. Is that kind of is that what you see in Europe and one of their big challenges?
From my point of view, I'd put it a different way. If you take all the central banks in the world, The central banks of the world collectively now own a significant percentage of government debt around the world, as well as some corporate debt. That was probably very necessary and very appropriate in the aftermath of the crisis. We're now 8 or 9 years beyond the crisis. We're not totally healed, but we've gone a long way. And so I think it makes sense now to start removing some of these very extraordinary measures. In our case, it's letting the balance sheet run down. We'll have to see what it is in the case of the ECB. But what I think you're hearing from central bankers, maybe including Mario Draghi, but I think you're hearing from me and from us is, I think we might be well served to now start winding down some of these extraordinary actions. And yeah, we have to be aware that there's no textbook for how you wind these down. And so we've got to be patient and gradual and learn from what we do. And so the best way to learn is take a step, watch, observe, learn from it, and do this in a gradual, patient way.
What about trade? I want to get that into the conversation too, not only because you travel to Asia, trading between these regions.
And we do a lot of work on trade at the Dallas Fed.
Well, and you've got right next to Mexico, so
right.
it's also very pertinent to your region. Are you concerned about the direction that trade is going? Are you concerned also about how this reflects on sort of the U.S. role in the world, how we're perceived overseas?
So let's take the first part. I actually think global trade is an opportunity for the United States. I think a lot of the dislocations that we've seen in the U.S. 10 and 15 and 20 years ago might have been because of globalization. Today, it's much more likely those dislocations are occurring because of technology-enabled disruption and other structural factors going on in the United States, as well as some cultural, where many young people prefer to live in big urban areas, including access to health care in rural areas versus urban. Those are bigger drivers than globalization. So my own concern is, if we attribute some of these problems to globalization, we're going to make poor decisions. Trade is an example, immigration is another. And I've said publicly, for example, in the trade relationship with Mexico is a good example. 70% of U.S. imports over the last number of years from Mexico, based on our research, are intermediate goods. Not final goods, intermediate goods. So what does that mean? These are goods that are going back and forth across the border that are part of sophisticated logistics supply chain management that have allowed U.S. companies to be more competitive, that allowed us to keep jobs in the United States. And if we didn't have those arrangements, you might likely see the U.S. lose jobs and lose competitiveness. So I think trade is an opportunity for the U.S. I think we'll do very, very well. Yes, I understand the desire, and I agree with the desire to make sure it's fair, that there's a level playing field, so that's healthy. But I don't think we should go too far with it. I think the more we're able to have global trade, the more likely it is that global growth will be higher and U.S. growth will be higher.
You know, Robert, speaking about trade, I want to talk about foreign exchange volatility, you know, the euro strengthening based on you know, one or two comments coming out from Mario Draghi back in June, and the dollar falling, given, you know, which way monetary policy rates are going to go here by the Fed. Have you been surprised by how sensitive the foreign exchange markets have been to Fed speak and ECB speak?
Well, they're sensitive to central banks, but I think they're also very sensitive to economic conditions. And European growth's been better this year. Global growth's been better this year. U.S. growth is about the same as last year. It's a little better, maybe a little bit over 2%. That may have more to do with the dollar relatively weakening and other currencies strengthening than necessarily central bank rhetoric.
So I want to ask you about this question of risks to the U.S., risks in Japan, risks in Europe. It seems like you just said maybe low inflation isn't so bad. You know, maybe things are changing. There's more growth. Balance sheet unwinding has started. But there is this question that's going to be raised tomorrow about financial stability. Where do you see the risks?
Here's the number one risk I still see is demographic.
Okay.
In most developed countries, population growth is slowing, workforce growth is slowing. And so I think Western world is going to have a challenge on how to grow more. And it's a problem because Western world is very highly leveraged, historically highly leveraged. You need GDP to service debt and to deleverage, okay? And so I think the opportunity and the risk for the world is that we pick the wrong solutions in trying to grow at a greater rate. So, for example, I think globalization probably is an opportunity for the U.S. to grow faster and for the developed world to grow faster in light of these demographic trends. Probably immigration in an appropriate way, I know it's a sensitive subject, is probably an opportunity for the United States. Trade's an opportunity, and I think the biggest risk is that we don't analyze the reason for slow growth as well as we should, and we maybe pick we pick policies that maybe create, in general, lost opportunity. So I think regulatory review is a healthy thing. I think infrastructure spending, if it's done properly in the U.S., could be a healthy thing. I think trade and immigration, if we are not careful, could actually impede possible GDP growth, and I'd like to see us avoid that mistake.